Tim Lawless, Research Director at CoreLogic, is my next guest on the one-on-one interview series. And I am really looking forward to this because I think we're going to see a little window into 2023. So here we go. I know we're transitioning out of a booming market to a downturn, and what do you think were the main factors in that occurring?
Well, I think clearly the main factor is interest rates, but it's really important to remember that some markets were declining in value well before interest rates started to go up back in May. We're seeing Sydney, for example, peak back around sort of January, Melbourne about March. And that was due to a whole bunch of other things around affordability becoming more challenging. We'd already seen quite a history of fixed mortgage rates rising. Consumer sentiment had been falling for more than a year by then. And inflation had already started getting, more than 1% quarter on quarter. So household balance sheets were already being impacted. But then on the 5th of May, as we started to see the first cash rate hike and then subsequent hikes after that, that was a real inflection point on the marketplace. We started to see housing price falls becoming much more broad-based and started to accelerate in the rate of decline as well. So clearly interest rates moving up were the catalyst, but it highlights just how sensitive households are. Remember, we're at a period now where household debt has never been this high. So it makes sense that households are probably a little bit more sensitive to rising interest rates, even though they are coming off record lows.
Yeah, that all makes a lot of sense. And we're at the tail end of a boom like we had never seen. I mean, it can't keep going forever, can it?
Well, it was unsustainable, absolutely. We saw housing values around the country were up about 26%. Just across the capital cities, even more than that across the regional markets. They were up about 40% through this very short and sharp upswing.
Yeah, no, they're incredible stats. So with your tracking mechanisms, which must be very complex, is there a lag? Is it like a week or a month, or before you really start to feel what a trend is, what's happening there in the marketplace?
Well, we do measure the market daily, and of course we have data feeds coming through on a daily basis as well. So the way we measure housing values is using a hedonic regression methodology. I know there's a bit of a mouthful, but essentially what that means is we're valuing every property or estimating the value of every property across the country based on what we know about that property at that point in time. It's not just what's sold around it. Obviously that's really important, but also how many bedrooms that property has, how many bathrooms, what size land is it positioned on, what sort of elevation is it, all those sort of things flow into the database. So absolutely there is a bit of a lag because we're not getting the data as soon as the contract is being signed, but we get about 75 to 80% of our data sales evidence coming through before the government records arrive. If we're to rely just on government data coming through, then absolutely there'd be much more of a lag in the readings on the market.
It's pretty quick, really, isn't it? You get a feel for what's happening fairly fast.
Absolutely, especially when you factor in a lot of the real-time data around, say, listings evidence, what we're seeing in terms of the changed attributes of properties as well is really important. So gone are the days of just relying on something really simple like a median price or something like that can be really skewed. These days, it's a much more sophisticated way to measure the market is to really use really heavy-duty analytics. But of course, that really requires some pretty heavy-duty processing power as well, which is part of this whole technological evolution we've seen across the industry.
And CoreLogic's got a lot of resources in that regard as well.
Oh, absolutely. I mean, we're investing about $20 million a year just in buying and acquiring data and managing our data. So it's our number one asset. Outside of our staff, of course, our underlying data sets are the most important part of our business. It's the building blocks for everything we do.
Sure. So you obviously got a real passion for data science and real estate together. What came first?
Yeah, it's quite the blend, isn't it? So absolutely, it was data sciences that came first. So the first job I had out of uni was with a company called MarketShare, which ultimately RP Data actually bought that company. And then I started to do a lot more work with residential property data at that stage.
Right.
And then went into Colliers, PRD and Colliers, and then came back to RP Data back in 2007, just as the company was floating on the ASX. And
Right.
there was a lot more investment in our data and our methodologies back then as well, which obviously has continued through. So absolutely, it started off with just loving working with data and property. Everyone loves property. That the blend of the two just seemed to be, an absolute dream job for me.
Has the way that you've captured the data changed enormously in recent times?
Well, not really changed in the way we capture the data. We've always worked really closely with the industry, with agents and with agencies, with the government to collect data and collecting listings as well. Probably what's more changed is the way that we work with the data and pair it with a whole bunch of other data sets. So think about one of the earliest projects RP Data was involved with. This is back in, must have been the early 2000s. We took a photo of every single property in the country. This was back in Ray Catlin's
That wouldn't
days.
take long.
So he basically had guys out riding on motorbikes, one guy driving, one guy in the back taking photos of houses.
And
This
now you've
is
got
like-
Mr. Google for that, right?
Well, this was way before Google Street View.
Yeah.
So absolutely visionary.
Yeah.
And so that was just a really good example of a way to invest in property. And that was when RP Data pretty much went from being a data company to being a company that, real estate agents could use to actually visualize property as well. In this day and age now, we're using a lot more cloud technologies. You've got things like artificial intelligence and machine learning that's coming into it now. It's even improving all the accuracy and the timeliness even more, and building in patterns you'd never even fathom that existed. So that's the beauty of machine learning, is identifying all these patterns in the data that you never really knew were actually there to begin with.
Okay, wow. I was thinking back to what you were saying about the ability of CoreLogic with your new analytical ability. Do you think that there'll come a time where you can be preemptive of what you think may occur in the market?
Well, that's always going to be the objective, to actually move to predictive analytics rather than reporting historically. And we do have some predictive products at the moment, more around propensity to list, for example, or propensity to sell. So we look at, for example, how long a property's been owned, what sort of ownership type it is, what sort of dwelling type it is, what's the normal tenure in the area. So some pretty early stages of predictive analytics. And there's already plenty of examples outside of CoreLogic where they have predictive models trying to forecast where housing prices are going.
Yeah.
There's still a lot of volatility in those models, and we know that a big part of those models is always going to be the macroeconomic assumptions behind them rather than the property trends themselves. So long story short, absolutely watch this space. We will definitely have more analytics out there which are predictive in nature, but we need to make sure we're getting it as right as possible before we're getting down that.
I know you're very responsible in that regard. Cycles normally in real estate were like 10-year cycles, and they've been that way for quite a long time. It seems to be speeding up. Is that your impression?
Yeah, I think that's probably a fair enough assessment. So if you think about some of the factors that are causing cycles to be more frequent or maybe a little bit shorter in the upswings and the downturns, a few things have happened. So go back to, say, the last major recession we had back in the early 1990s. Back then, we're still seeing the RBA without an inflation mandate. So inflation was a lot more volatile. Interest rate or policy was a lot more volatile as well. So remember late 80s, early 90s, that's when everyone talks about mortgage rates being up around 17 to 18%.
I remember.
That was one of the factors back then. Now we see inflation and monetary policy tends to be in a much more narrower band. You've also got the fact that over time, we've progressively been seeing interest rates coming down and down and down. Very rare to see any break in that cycle, which is probably what we're seeing now, is that progressive downward cycle of interest rates probably can't really go any lower than what it reached through the pandemic.
Yeah.
So that's been another factor. And then probably the final factor is household debt levels have been consistently getting higher and higher as well, which of course makes households much more sensitive to changes in the environment, particularly interest rates, but also other things like the cost of living, inflation is having a double whammy effect at the moment. Housing affordability's become generally more and more challenging over time as well.
Yeah. Apart from monetary policy, what sort of data indicators can you foresee for the market in 23?
So I'm flat out trying to know what's happening next month, to be honest, but I'll give it a go. So I think 2023, say the first quarter of 2023, hopefully by then we've seen interest rates stabilise.
Yep.
But chances are, if inflation's under control, we'll start to see interest rates level out.
Yep.
Maybe even come down through the second half of next year. I think by then we'll also have seen housing prices come down maybe 10 to 15%. So buying opportunities are going to be much better.
So that's the adjustment that was required, and from there, you think there's some upward.
Absolutely,
pressure,
yeah. Probably not. I don't think we'll be going straight into another, growth phase.
Yeah, sure.
But the way the market cycles normally work is you see housing prices rise.
Yes.
Those rises
No
slow
surprise,
down,
really,
then it
is it?
falls, and then
Yeah.
it stabilises, and it rises again. So
Yeah.
I think by late 23, maybe coming into early 24 is when we'll start to see a renewed growth cycle. But again, it really depends on how the economy is going,
Yeah.
how inflation is tracking, and of course what interest rates are doing.
Yeah. Oh, that's great, Tim. Mate, thank you so much for coming in. It's been wonderful, and I really appreciate it. Thank you
Thanks
so
very
much.
Absolute pleasure.
Great.